Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Graham Day, Chief Investment Officer at Innovator Capital Management. Innovator offers 131 ETFs with 19.4 billion in AUM, and they pioneered the buffer or defined outcome ETFs. They launched the world's first buffer ETF in 2018, and these ETFs in general, they allow investors to participate in the market upside up to a cap while limiting losses if the market falls. And last year, Innovator launched the world's first 100% protected ETF. So we'll talk about the market outlook today and these protection products. Graham, welcome. Great to have you on the show.
Thanks so much, Nina. It's great to be here.
So we are recording this on Friday, July 12th, and yesterday was a historic day for markets because investors sold last year's winners, particularly the Magnificent Seven stocks, and piled into small cap stocks and other attractively valued areas of the market. And this huge violent rotation happened mainly because inflation reading yesterday's CPI report was much cooler than expected, and it raised the odds for the Fed to start cutting rates in September. And before this, in the first half of the year, just 5 mega cap companies, NVIDIA, Microsoft, Apple, Amazon, and Meta platforms, they had accounted for about 60% of the gains. And NVIDIA alone had accounted for almost a third of the gains. So I wanted to start with your outlook for the markets and which areas look attractive to you. How should investors be thinking about positioning their portfolios for the second half?
Well, Nina, yes, you're absolutely right. A lot has transpired, especially yesterday. We saw the 5% divergence in performance between small caps and large caps. And, I think what we have found is in many ways, the easy money has been made. If you look at the performance of the S&P 500, the NASDAQ 100 over the last 2 years, they are annualized returns they've delivered annualized returns of 23 to 33%. And we all know that is not a sustainable pace. And so from our perspective, in many ways, it's a optimal time for advisors and investors to start looking to stay invested, but also begin protecting some of those gains that they've had. I think something else that is really top of mind for advisors and their clients is the election. A number of studies have been coming out showing that investors are most concerned about the election coming up. And so what does that mean? It means that they're looking to protect their portfolios. And so that's where our 100% buffer ETFs, particularly our 6-month 100% buffer ETF, is ideal because it allows investors to stay in the markets, get upside, but fully protect the market downside. So again, we think easy money has been made on the equity side. Bonds continue to be a problem for advisors. Generational opportunity. That's what we heard back in 2023 for bonds, and into 2024. Bonds have really not delivered that. In fact, they've delivered the highest level of volatility in a portfolio in the last 40 years. We think that volatility is going to persist for the foreseeable future. And so really the problem with bonds has caused advisors to rethink risk management. Bonds used to be that reliable risk management tool. And if they cannot deliver that risk management like advisors have been used to, That's where we continue to see advisors looking towards the certainty that defined outcome ETFs can provide, reliable downside protection, known outcome potentials, and that's playing equally well into the reasoning for 100% buffer ETFs.
Right. So for investors who believe that easy money has already been made, as you mentioned, it is the right time to start looking at protecting their portfolios. And these buffer ETFs, defined outcome ETFs, they have been quite popular with investors, particularly after stock markets and bond markets' terrible performance in 2022. And assets in these strategies have grown to about $46 billion. That is according to Bloomberg data. And as I mentioned, Innovator had pioneered these products, and many other providers, including BlackRock, have joined this race. So could you talk about the reasons for the surge in popularity of these defined outcome and defined protection strategies?
Nina, I think it really stems to advisors and their clients crave reliability. They crave predictability, and they are willing to forego potential uncapped upside to ensure that they know that they have built in protection in their portfolios. And we always come back to the high level of 75% of all the wealth in the US is in the hands of pre-retirees and retirees. These are individuals who are no longer interested in putting all of their capital at risk. They are as interested in capital preservation as they are capital appreciation. And so back in 2018, markets were doing very well. We saw some advisors starting to use these to hedge some of their equity positions. But I think a huge catalyst for the growth of these ETFs was in 2020, not only because of the COVID sell-off, the massive decline, temporarily decline in equity prices, but really it was the bond side of portfolios that I think put these products into the spotlight. And I mentioned that because advisors at that time looked at bonds, and bonds were yielding zero. Short-term bonds were at 0%, core bonds at 1% yields. And we had advisors coming to us saying, the easy money has been made in bonds. If you look at the yield to maturity of a bond, it is telling you that is what you should expect to receive in the future. And so if you're presented with a 1% bond yield, but you're taking on the duration risk of that bond, the credit risk of that bond, your risk reward is heavily skewed against you. And so what we found was advisors were looking to trim their bond positions at that time, but they could not tell their clients we're going from a traditionally risk averse asset class to unhedged equity exposure. And that's where buffers came in. Buffers were a way to maintain a known defensive posture, but tie those defensive assets to the equity markets. And over that time frame, those advisors and their clients have been very pleased with that move, where bonds since that time frame are flat or negative, and the power buffer ETFs have appreciated over 8% a year. And so those are the use cases that we have continued to find advisors are able to use these ETFs to address a wide variety of risks in their portfolios, whether it's concerns on the equity markets, whether they are looking for alternatives to bonds, whether they're looking for a way to diversify their alternative asset class sleeve. These are all methods to implement these ETFs that, quite frankly, we were not thinking of when we first launched these products back in 2018. So it's exciting to see how these products have been adopted. But I think it comes back to, why do they continue to gain traction? It's because they work. They do exactly what they say they're going to do. And that's the reliability, that's the certainty that advisors and many of their investor base crave.
All excellent points. Now let's talk about how these products work. So I understand these ETFs, they invest in a basket of flex options with varying strike prices. So could you explain what exactly they hold and how they work?
Absolutely. And when we talk to advisors and they hear flex options, I think the initial reaction is, these sound like pretty complicated products, but they in reality are actually amongst the most simple products that we have ever built in the ETF wrapper. And so if we think about our 100% buffer ETFs, how do we build those? Like you said, Nina, we use options. Options provide that objective risk management. They do exactly what they're supposed to do. And there's only 3 options positions in these 100 buffer ETFs. First, we start with a deep in the money call. To simplify, that is just 1-for-1 exposure to the S&P 500 ETF. And with that option position, we get the implied dividend or financing rate of the S&P, and we use that to purchase the 100% downside buffer, one put option that protects 100% of the portfolio. Now, typically, the financing that we receive from that first option position is not sufficient to cover the full cost of the second option position. And that's where the third and final options position comes in. And that's where we sell a call at the highest level possible to generate enough income to cover the remaining cost of that put option. That sold call is the cap. And that cap is put in place for our 6-month 100% buffer. We sold that cap at 5%. So that means over 6 months, you can track 1-for-1 with the S&P 500 ETF up to a 5% cap. And once those 3 options positions are fixed, we do not touch them until the end of the outcome period. Once the end of the outcome period is reached, we will simply rebalance these options positions, provide a fresh upside cap, reset the downside buffer, and it's all done within the tax efficient ETF wrapper. We do not anticipate any taxable distributions from these ETFs, and that is a massive value add over existing, or we should say legacy structures that have provided these payoffs in the past. So these grow on a tax deferred basis, which again, advisors and their clients, if there's one thing that they can mitigate, if it's taxes, they are absolutely going to try and do that. And so it's another way that the ETF wrapper has shown its benefits to advisors and their clients.
Excellent. So simple to understand. Deep in the money call to get exposure to the index, then add the money put for 100% protection, and then selling out of the money call, which caps the upside. So let's talk about that cap, because I read that rising rates have pushed those caps higher, making these products more attractive to investors. So for the benefit of our listeners, could you explain how higher rates have made these protection products more attractive?
Absolutely. And if we go back to just your last question and referencing the 3 different options positions that we use to construct these 100% buffers, that first option position, the deep in the money call, I mentioned that there's the implied financing rate that's included in that option. And so as interest rates rise, the implied financing component of that option also rises. What does that mean? That means that we have more money to cover the cost of the second option. the at the money put. And because we have more to cover the cost of the at the money put, that means we require less income from the third options position, the sold call with the cap, to cover the remaining cost of the at the money put. So it allows us to sell a call at a higher level than if interest rates were lower. So that's really the reason behind interest rates driving the caps higher. It's also important to note that volatility will also benefit the upside caps of these structures as well. But we see interest rates being a primary driver of the upside caps for the 100% buffer ETFs.
Very interesting. So should investors expect lower caps going forward if the Fed starts cutting rates, say in September? Because after yesterday's CPI report, the odds of a rate cut in September have really gone up. So is it time for investors to lock in these attractive levels of caps or upside potential for a longer period? Because you now offer 6-month, 1 year, and 2 year outcome periods. So is it time for investors to lock in at these caps for the 2 year outcome period? How should investors choose between 6 months, 1 year, and 2 year?
Yeah, Nina, that's a great question. And I think you're exactly right. The same reason why we have seen advisors and their clients moving towards money market funds. A stat that we quote, and it's really a problem that we see advisors looking to address, is after 2022, their clients wanted to go to cash. They saw that yields were around 4%. They looked appealing. Bonds had sold off, equities had sold off. And we have seen allocations to cash for ultra high net worth clients swell to almost 30%. Advisors need tools to get that cash off the sideline in the market. The problem is when you're in cash, you want certainty. You are more interested in capital preservation, full capital preservation, than hitting home runs. And so we have found that these are tools to help advisors get some of that cash off the sidelines. So the 6-month 100% buffer ETF that we offer, that's the shortest outcome period. It lines up most closely with cash-like exposure. It would be more susceptible to interest rate changes than the 1 year or the 2 year. That's why we offer the 1 year or 2 year. And so for advisors that have some of that cash on the sidelines, they want to maintain that short maturity type exposure. That's where we're seeing them using the 6-month 100% buffer ETF. But as you pointed out, all indications are the Fed will cut rates within the next 2 years. And so if you want to lock in a higher rate for the next 2 years, that's why we have the 2-year 100% buffer ETF. And so it really comes down to what advisors are thinking, what risks they're trying to mitigate, where they would be fitting these in their portfolios. But primarily the 6-month 100 buffer, that's where we see it being used as an ultra short-term bond, cash alternative. The 1 year being somewhere in between, again, short-term bond, maybe advisors that are a little more comfortable moving some of that cash into 1 year product. And then the 2 year is more of a bond alternative, a way to maintain 100% downside protection, but give investors upside potential. Right now, we have 18.2% on the upside. That upside, and really not only on the 2 year, but the 1 year, the 6 month, that upside is materially higher than any yields that you're seeing on fixed income instruments, CDs, cash. And the other thing that we always point to advisors, Nina, is the tax efficiency of these ETFs. We expect these ETFs will grow on a tax deferred basis. And so if we think about the capital pool that advisors are pulling from, cash, bonds, CDs, to move into these ETFs, those are tax inefficient instruments. CDs, bonds, all deliver ordinary income. Structured notes, ordinary income. Annuities, those grow on a tax-deferred basis, but when they come due, they are taxed at ordinary income rates. To be able to defer gains in the ETF wrapper and grow tax-deferred, and potentially, if you hold for a year and a day, achieve long-term cap gains, that's the type of value add that advisors are looking to provide their clients. It's a way to differentiate their practice. Every advisor is using bonds. They're using CDs. They're using money market funds. But what if you could offer your clients similar downside protection, better upside potential, and tax alpha? Those are components. Those are solutions that we're seeing advisors put into play today.
Yeah, the ETF wrapper is so much more tax efficient compared to other products. So you talked a little bit about other protection products. These include fixed index annuities, market-linked CDs, etc. They provide protection against markets downside risks. But I understand that they also come with much higher fee, some high investment minimums, and long lockup periods, in addition to the unfavorable tax treatment. And these protection ETFs, they are a much better option for investors seeking these kind of protections. So could you talk a little bit more about how the ETF wrapper is superior to other protection products, and how big is the market for other protection products? So if investors come to the ETF wrapper from those protection products, then probably we will see even more growth in buffer and defined outcome, defined protection ETFs going forward.
Yeah, I think that's absolutely right. And maybe even to take a step back, I think it's worth pointing out that Innovator was founded because one of our co-founders purchased an annuity that had structured notes embedded inside of it. And long story short, he thought, why can't this be done in the ETF wrapper? It was illiquid. There was lockups. He couldn't get out when he wanted to, but it offered something valuable, a known outcome. And that's really the genesis of Innovator. Is we will be the first to say these payoffs have been around for decades. They've been around through insurance products, through bank products. But what we've done at Innovator is to make them accessible, to democratize access to these payoffs for the first time in the ETF wrapper. And we have found that the benefits extend to advisors and their clients, and they are material. The first is those legacy wrappers carry the credit risk of their issuing entity. Whether it's a bank note, whether it's an insurance, an annuity, you are taking on the credit risk of those issuing entities. And we always point out to advisors that credit risk doesn't matter until it does. And it matters at the worst possible times. It matters when you need that defense to pay off. But it's when those institutions may be least able to make good on their obligations. And so that's why we see the ETFs do not have credit risk. They are fully liquid. You can get in and out at any time. They're 1099 tax treatment. One of the things we talk to advisors is if you're using annuities or structured notes, oftentimes it's separate client paperwork. It's not easy to allocate across their practice. The ETF solves for that problem. It solves for the credit risk. It solves for the illiquidity. These are fully liquid instruments. And as we mentioned earlier, these are fully tax efficient. And that's something that, again, if you can help your clients control their taxes, that is a huge value add. And Nina, you asked about the size of this space and what we're looking to disrupt. And having spent my entire career in the ETF industry, it's sometimes hard to really appreciate how big the market is for risk managed solutions. In 2023 alone, we saw over $260 billion in sales of insurance products that gave full downside protection, as well as some sort of upside to the equity markets or some interest rate credit. There is a massive market for risk managed solutions. And so you mentioned earlier that the defined outcome ETF space is over $40 billion. Well, that's AUM. And the number I just referenced on the insurance side, that is what was sold in 1 year alone. And so we feel like we are just getting started. And these 100% buffer ETFs that we pioneered back in 2023 have a massive opportunity to disrupt the legacy insurance and bank wrappers. And so we feel like we're just getting started.
Amazing numbers. So we talked about how these products work and what they hold. So it seems that they hold three types, as we discussed, they hold three types of options contracts. So can investors use those derivatives themselves to create a strategy with similar outcomes? Will they be able to achieve a similar kind of tax efficiency if they try to do this themselves?
To answer your second question first, the answer is no. And that's one of the main reasons why we see investors using our ETFs, is because they know that if they are going to manage the options themselves, if they can, most advisors are not even allowed to trade options, but they cannot achieve the tax efficiency that the ETF wrapper provides. So right there, that is a massive value add to advisors and their clients. Now, we have talked to teams that manage tens of billions of dollars, and they have done exactly, Nina, what you said. They have gone out and said, we want to see if we can price these out and get the same parameters that your ETFs offer. And they have come back and said, how are you able to provide such good parameters? We went to price out, say, a 15% buffer, or let's stay with the 100% buffer ETFs. And over 1 year, we're able to price out a 7.5% cap. How are you able to deliver a 9.5% cap? And again, that's where the benefit of the ETF comes in, where we've achieved economies of scale here at Innovator. And we have a pool of liquidity that is being fought over. There's competition amongst the largest options trading firms in the world. We're talking about Jane Street, Susquehanna, Old Mission, Wolverine, Citadel, some of the world's largest banks as well. And so by putting the market into competition, we are able to extract the highest cap possible to the benefit of the end investor. And I think that that is also a key difference versus the legacy wrappers. If you are buying a structured note, or if you're buying an annuity, you are getting the upside cap that's been given to you by that issuing firm. It has not gone into competition. And so on the ETF side, whether it's the options, if they're putting the market in competition to get the highest upside potential for the investor, extending that even into the ETF trading itself. If you're going to buy these ETFs in the secondary market, those same groups are competing for your order. That's why spreads are very tight with these ETFs. There's an enormous amount of liquidity, but it's for really those two reasons: the lack of tax efficiency if you're trying to manage these, if you can manage these options positions on your own, but then also these larger teams that have tried to price out similar option structures, they are unable to achieve the same type of upside that we are through the ETF.
Very interesting. Now let's talk about the use of these strategies in investor portfolios. And you mentioned earlier that bonds are not providing risk mitigation benefits, diversification benefits that they used to provide in earlier decades. And you also talked a little bit about how some of these products are more superior to bonds. So how much allocation do you recommend? And do you recommend that these protection products should be a part of the fixed income sleeve in a 60/40 portfolio?
That's a great question. I think what we have found is the use cases of even the 100 buffers are diverse. We have primarily found that they're being used to help their clients, help advisors' clients get off the sidelines, to move some of that cash into the equity markets. But as you mentioned, and as we've talked about here earlier, advisors are frustrated, and their clients are frustrated with bonds. And they're wondering, why do we own bonds? Do we own bonds for the income? Well, we can get 5% right now in money market funds. Or are we owning bonds because we are hoping that they're going to diversify us in times of market stress? Well, 2022 showed that you cannot rely on bonds to provide that hedge. So if you're using bonds to hedge, that's where we're finding advisors also saying, we're not going to completely give up bonds, but we're going to trim back, or we're going to maintain an underweight position in fixed income for the foreseeable future and utilize the buffer ETFs, the 100% buffer ETFs, as a way to maintain a defensive posture, but then also have more upside potential. Traditionally, equities give you more upside potential than bonds do. And the third component of that would be the tax efficiency, that as advisors have been using bonds to hedge their equity portfolios, they are, unless you're holding these in tax deferred accounts, if you are in a taxable account, you are taking on these ordinary income distributions of bonds unnecessarily. The buffer ETFs grow tax deferred. And that's another way that we're seeing advisors incorporating these portfolios. So, Nita, maybe to answer your question about what percent of the portfolio do we see advisors incorporating buffers with, I think what we found is taking a 60/40, we've seen advisors maybe take 10% of their equity sleeve, move those into the buffer ETFs, and then probably that 40 allocation to bonds, they're taking 15 or to 20% of their bond allocation and moving it into buffers. So rethinking the 60/40, we're seeing it become more of a 50, 20, 30, 50% in equities, 20% in bonds, 30% in a mixture of these buffer ETFs, whether it's a 15% buffer ETF or 100% buffer ETF. And we think that that's going to be the norm going forward. People are trying to rethink the 60/40. And one interesting stat that I would pass along on bonds, because we're asked, well, when will bonds deliver diversification again? The research that our team here has done has shown that it's when inflation is sustainably lower for an extended period of time. I know you mentioned that CPI came in a little lower than expected. What our research has shown is that it takes a long time for inflation to fully subside. And it's when core inflation is around 2.25%, or for over a 3, 4, 5-year time frame, that's when bonds start delivering diversification again. Right now, though, our 3-year average core inflation, we're still above 4%. So we believe it's going to be some time before bonds deliver that, if we want to call it magical diversification that they provided for many years in the past. We don't know if that's going to be coming back anytime soon. But even then, even when it does come back in, we continue to have advisors looking at these ETFs because they realize there's more upside potential to the equity markets long term than bonds. And so The buffer ETFs fall somewhere in the risk spectrum between equities, between bonds. They're not bonds. They don't provide income. They're not equities. They're tied to the equity markets, but they have built-in downside protection. So in many ways, we view buffer ETFs, or 100% buffer ETFs included, as a new asset class that advisors have now to use to manage risk. They don't have to just manage equities and bonds. They've now got this new tool at their disposal.
Excellent stuff, Graham. We'll have to leave it there. Thank you so much for joining us today and for sharing your insights.
Thanks so much for having me, Nina.
That was Graham Day of Innovator. Now, Innovator has a very nice suite of buffer ETFs and the world's first ETF with 100% downside protection that they launched last year. The ticker symbol is TJUL, TJUL. And as we discussed, they expanded their suite recently, and now they offer these 100% downside protection ETF with a 6-month outcome period, 1-year outcome period, and 2-year outcome period. So if you are worried about the election-related uncertainty, and if you want to look only at 6-month outcome period protection, then the ETF is JAJL. But if you believe that the Fed will start cutting rates later this year, and this may be a good opportunity to lock in those high rates, then probably you should look at the 2-year outcome period, and the ticker symbol is AJUL. In addition to Innovator, other providers also offer these buffer and defined protection ETFs. First Trust has a nice suite. Calamos recently introduced many of these protection ETFs, and we, in fact, had Calamos on the show recently. BlackRock also offers buffer ETFs, and they also expanded this suite with the launch of an ETF that provides 100% downside protection recently. And these products are great for investors who are risk averse, particularly those who are already in retirement or nearing retirement. And as we talked about cash on the sidelines, there's more than $6 trillion invested in money market funds and a lot of cash in other cash-like instruments. So for those investors, these products make a lot of sense. But I believe that for most long-term focused stock investors, they should just stay invested in the market and ignore any short-term fluctuations, because over the longer term, stocks go up. Since its inception in January 1993, SPY, the most popular ETF, has returned a little over 10% annualized. That is the S&P 500's return. And the NASDAQ 100 ETF, that has produced almost 19% average annual return over the past 10 years. But again, for risk-averse investors, these protection products, buffer ETFs and 100% downside protection ETFs make a lot of sense, and they are much better than cash. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.